Welcome to Griffonomics.
It's great to be here for this one.
Yeah, so imagine spending nearly $10 billion to build this ultimate insurance juggernaut.
Right, meticulously piecing together the largest acquisition in your company's history.
Exactly. Only to just stand there and watch your top performers and, tens of millions of dollars in client revenue just walk right out the front door to a rival.
It's a brutal scenario.
It really is. So today, for you listening, we are doing a granular, investigative deep dive into Brown and Brown. You might know them by their ticker, BRO.
A very fitting ticker for a heavily relationship-based industry.
Yeah, true. We're looking at their fundamental transformation through mega M&A and their fierce defense against this aggressive talent extraction we just mentioned.
And we're pulling this from a really pristine stack of financial sources today.
We are. We've got Brown and Brown's 2025 10K, their Q4 2025 earnings call transcripts, some pretty harsh Wall Street analyst notes, including a major downgrade from Citi and key press releases about their share repurchases and strategic expansions.
It's just a fascinating stack of documents because you have a company at this profound crossroads.
Right. Like, how does a company post this massive 22.8% revenue surge while at the exact same time they are fighting a bitter talent war where a competitor just poached 275 of their teammates?
It's a massive contradiction on the balance sheet.
Okay, let's unpack this. Before we can really understand the billions of dollars changing hands in these acquisitions, we have to understand how Brown and Brown actually makes its money.
Right, establishing the baseline.
Yeah. So they are an intermediary powerhouse. They operate primarily as an agent or broker, meaning they do not assume underwriting risk.
Well, with a few slight exceptions.
Sure, yeah. They have some captive insurance facilities and a write-your-own flood carrier, but mostly they don't hold the bag if a hurricane hits. They focus on property and casualty and employee benefits.
And they recently went through a big segment realignment, right?
They did. They consolidated into two main segments. You have retail, which is your standard risk, and then specialty distribution.
Which is the complex stuff.
Exactly. Excess and surplus risks. This includes Bridge Specialty Group and Arrowhead. But looking at their revenue mix, they make money via base commissions, fee-based services, and profit-sharing contingent commissions.
Which is a really vital piece of the puzzle.
I mean, I kind of look at their business model like a real estate agent, right? They take a commission for connecting the buyer, the insured, with the seller, who is the carrier.
That's a solid analogy.
But wait, so they get a bonus from the carrier if the policies they write end up being highly profitable and don't result in claims. Doesn't that mean their success is inherently tied to the unpredictability of natural disasters?
What's fascinating here is how those contingent commissions act as a major structural advantage in a good year.
Right, if there are no storms.
Exactly. But they absolutely introduce volatility based on storm claim activity. If a massive hurricane wipes out the carrier's profitability in Florida, Brown and Brown's contingent commissions from those carriers can basically vanish for the year.
Wow, so you're totally at the mercy of the weather for that chunk of revenue.
You are, which is why you want to diversify.
Here's where it gets really interesting. You don't become a powerhouse just by selling policies one by one to outrun that volatility. You buy market share.
You buy a lot of it.
Yeah, and 2025 was a record year for them. They completed 43 acquisitions. But the crown jewel was the Accession Risk Management Group deal.
Formerly known as Risk Strategies and 180 Intermediaries.
Right. This was a $9.6 to $9.8 billion mega deal, easily the largest in the company's entire history.
It brought in over 5,000 new teammates, which is just a staggering amount of human capital to absorb.
It's huge. And management's synergy roadmap expects $30 to $40 million in EBITDA synergies in 2026, with full integration targeted for 2028.
They're highly optimistic about those synergies.
But I've got to push back on this. Integrating 5,000 people and who knows how many legacy IT systems, that sounds like a cybersecurity and cultural nightmare. Are they actually pulling this off, or did they bite off more than they can chew?
Well, it's a very real concern. And if you read the 10K, it explicitly lists the complex integration of Accession's information systems as a major risk factor.
I mean, I would think so.
Yeah, they literally warn about unexpected cybersecurity vulnerabilities and potential data breaches. When you buy a sprawling network of brokerages, you inherit every single patched-together server and weak firewall they ever built.
So they spent nearly $10 billion on Accession. Did that massive bet actually translate into balance sheet dominance for fiscal year 2025?
Yes and no. The top-line surge is undeniable.
Total revenue hit an incredible $5.9 billion for the full year. That's a 22.8% year-over-year increase.
Right, but remember, that's largely driven by those 43 acquisitions adding $1.8 billion in annual revenue.
Yeah, because if you look closely, Q4 organic revenue actually contracted by 2.8%. So it's easy to grow revenue when you buy 43 companies, right?
Mm.
But if organic growth is contracting, aren't they just masking underlying weakness with a massive shopping spree?
If we connect this to the bigger picture, you have to look at what happened in late 2024.
Okay, lay it out for us.
That organic contraction was largely due to a uniquely tough comparison. In Q4 of 2024, they had a massive $28 million flood claims processing revenue bump.
Ah, right, because they operate that write your own flood carrier.
Exactly. They get processing fees when massive storms hit and FEMA claims spike. So Q4 of 2024 was abnormally high, making Q4 of 2025 look like a contraction by comparison.
Oh, wow. Okay, so it's an accounting echo, not a broken sales engine.
Right. And despite a temporary Q4 margin flattening because of the way Accession's revenue phased in, management is incredibly confident.
Yeah, they actually officially raised their long-term adjusted EBITDA margin target to 32 to 37%,
Up from 30 to 35%.
which is a bold move.
Yeah.
And the underlying cash flow engine is healthy enough to support it. I mean, they're generating $1.45 billion in operating cash flow.
Which is an impressive 24.6% of total revenues.
But to fix that organic growth problem and actually hit those upgraded margin targets, they know they can't just rely on acquisitions forever.
No, eventually you run out of things to buy, or the debt gets too expensive.
Right, so they have to innovate and capture these highly specialized, complex niches.
And we are seeing that with the new national healthcare practice they just launched.
Yeah, this is a fully integrated unit. They brought together more than 140 professionals just to handle complex healthcare risks.
Stuff like professional liability, managed care reinsurance, value-based care, high margin, high expertise areas.
And parallel to that, they are actively deploying artificial intelligence and robotic processing automation, or RPA.
Right, to enhance operational efficiency.
Boost productivity, improve electronic carrier interactions. I kind of compare this to modern warfare, honestly.
How so?
Well, you don't just need a massive army for scale anymore. You need elite special forces, which would be that healthcare practice.
Sure.
And you need advanced drones, which is the AI and RPA, to win the high-margin battles. You have to have both.
That's a great way to look at it because building these elite, highly specialized teams creates massive value for the clients. But it also puts a giant target on the backs of those very same employees.
And that brings us to the most dramatic part of this deep dive. Because when you build elite teams of specialists in a highly competitive industry, other companies will try to steal them.
And things just got really ugly.
Yeah, they did. We're looking at a full-blown talent war crisis. A startup U.S. broker competitor executed a highly coordinated plan to lift entire teams.
And Wall Street analysts have pretty clearly identified this competitor as Howden.
Right. They poached approximately 275 Brown & Brown teammates.
Just an unbelievable number of people to lose in one go.
And the financial hit is immediate. This talent drain took customers representing $23 million in known annual revenues straight out the door.
CEO Powell Brown even had to address it directly on the earnings call. It was that material.
Yeah, and Brown went on the offensive. They obtained a legal injunction to protect their non-solicitation agreements and intellectual property rights in perpetuity.
Which they had to do.
But let me ask you this. Is this really poaching? Or is this just the free market at work? Like, if a competitor offers a better deal, shouldn't employees be allowed to leave?
This raises an important question. Normal attrition is one thing. If an employee leaves for a better salary, that's the free market.
Right.
But a coordinated extraction of intellectual property and entire client rosters is different. You aren't just hiring a person, you are systematically transplanting a book of business that Brown & Brown spent capital to build or acquire.
Ah, so that's why the courts granted the injunction.
Exactly. It was based on the strict 2-year non-solicitation covenants in their contracts.
Yeah.
You can't just bypass those agreements by lifting an entire team simultaneously.
But Wall Street hates uncertainty.
Yeah.
And watching 275 employees walk out the door with $23 million in revenue is basically the definition of uncertainty.
It definitely spooked the analyst.
How is the broader market reacting to this talent war?
Well, Citi recently downgraded Brown & Brown stock to neutral.
Did they specifically cite the poaching?
They did. They specifically cited persistent talent competition risks and a slower than expected 2026 growth rebound as the reasons for the downgrade.
And you have to factor in the debt and dilution, too. To fund that massive Accession deal, their total debt spiked to $7.6 billion.
That's a heavy debt load.
And the share count rose 19.4% in Q4, which dilutes existing shareholders. Granted, BRO is trying to counter this with a $1.5 billion share repurchase authorization.
Yeah, including a $250 million accelerated buyback. But financial engineering can only go so far when the macroeconomic environment isn't helping.
Right, let's talk about the E&S softness. Property rates in the excess and surplus market are down 15 to 30%.
Which is a massive headwind for their specialty distribution segment.
Because there is abundant capital flooding the market, and we've had relatively low storm losses recently. So carriers drop rates to compete, and since the broker commission is a percentage of the premium.
The revenue drops right along with it, even if they're doing the exact same amount of work.
So what does this all mean? They have the biggest market share in their history, but they are carrying massive debt, fighting a talent war, and facing softening property rates.
It perfectly synthesizes the pressures that validate Citi's skepticism. If you look at the projections, the specialty distribution segment looks likely to undergrow the E&S market by about 100 basis points.
Wow.
Yeah, proving these headwinds are very real, not just theoretical.
So it's time for the final verdict, the M&A compounder test. We have to weigh the sheer force of their M&A growth engine against the drag of this talent drain and market softness. What is the final verdict for you, the listener?
Strategically, it's rated as a moderate buy, but with high competitive risk.
The bull case is obviously that long-term free cash flow engine. I mean, 24.6% of revenue is remarkably robust.
Absolutely. And the $30 to $40 million in expected Accession synergies, plus those upgraded 32 to 37% margin targets, it shows really strong fundamental health.
But the bear case?
The bear case is that talent tax. The Howden poaching is the primary 2026 variable. If they can't stop the bleeding of their top performers, the M&A growth will just be filling a leaky bucket.
It's wild to think that their ultimate success in 2026 really depends heavily on their legal team's ability to enforce those non-solicitation contracts in court.
While at the exact same time, the operations team has to seamlessly integrate 5,000 new Accession employees. It's a high-wire act.
Yeah, it really is.
But I'll leave you with a final thought to mull over.
Lay it on us.
We talked earlier about Brown and Brown actively deploying AI to streamline the insurance placement process, right?
We're making things faster, more efficient.
Well, if AI eventually makes complex risk assessment and policy placement completely frictionless, does the value of these highly paid, fiercely poached human brokers actually go down over time?
Oh, wow.
Will the talent war eventually be replaced by an algorithm war?
That is a fascinating shift to think about.
It really is.
Risk defined, portfolio protected.